Hey everyone, I wanted to give a brief update on earnings releases from two of my largest holdings. The first one is LCFY. So LCFY is out with third quarter results, and pretty much as expected, the revenue numbers are not particularly impressive. So if you have a look, overall revenue decreased 28%, and that was pretty much foreshadowed anyways. We knew that quarter was not going to be good, but we have some indications of things improving, and that is they highlight that the business is picking up, meaning the bottom is likely in. If you read this line, the decline ceased in January, forming a base from which the company expects to grow in the coming quarters. Meaning, January was the last quarter where they saw declines in subscription revenue, and keep in mind it is now May. They would not write a sentence like that if they were not very, very sure, right? And they know it, that subscription revenues are increasing. So going forward, these declines, certainly on a sequential basis, I think also on a year-over-year basis, should be gone. And I would not be surprised if the fourth quarter is flat year-over-year. Have to dig a little bit more into the numbers and work on my expectations. But we know for sure now that the revenue has bottomed. And not only that, if you have a look at this percentage number, revenue declined by 28.3%, but on the cost side, cost of sales decreased even more, leading to a higher gross margin, and also operating expenses also decreased more on a percentage basis. So overall, what you have is a net loss that is meaningfully less, and also less cash burn. So they are very much moving in the right direction. And going forward, I think all those numbers are going to be pointing in the right direction, which is higher. I think, but I'm not yet sure, that in the fourth quarter they should be probably break even, certainly not far away. And I'm also fairly comfortable now with their cash position. I was a little bit worried just a few weeks ago, but they are working on a number of things, such as stretching their payables. If you have a look at the balance sheet, for example, you will see that payables are up quite a bit, and the cash position with just below 500,000 Australian dollars is not comfortable, but at the same time receivables are also up a little bit. And again, I'm expecting in the fourth quarter, which is now fully going, and there's not so much left, I fully expect them to be very close to break even. And additionally, there is some scope of getting prepayments. For example, they are working on a deal with the big media publisher to do some service work for them. And that is one of the examples where they would get upfront payment, and all of that would pretty much alleviate their cash needs for the foreseeable future. And then, of course, in Q1 of 2025, right, I think they should very well be profitable and start throwing off cash. And then questions about their cash position are not even an issue anymore. Now, keep in mind also, they tapped the ATM a little bit. Looking at the cash flow statement, right, you can see proceeds from issuance of shares, 567,000 Australian dollars. So it's not a lot. It certainly kept them going, certainly helped also in terms of equity position for the NASDAQ listing. But yeah, overall, it's not a great report. Obviously, we didn't expect a great report, but the bottom is in, and I especially appreciate all the additional information they put in there about revenues bottoming, bottoming, about this description here, like what is the business actually doing now? There's been a lot of movement, right? And now clearly they're spelling out here 3 core markets, how they think about them, and some commentary about the next fiscal year, fiscal 25. So a lot of these things, right? We have given them a lot of feedback that people just don't understand properly, like what the company is up to right now, because there was a lot of information spread between different press releases and so on, and now it's basically put together. So yeah, overall, certainly not happy with the decline in revenue, obviously, but I'm very happy about how the company is set up now, with the expectation of things really turning around, or having turned around actually already. It's just that we need to see it in the numbers. The other thing is I've learned that with the deal with Didner that they have announced recently, they're obviously approaching end clients, and I've learned the first deal with an end client with Didner is now also finalized. I have no idea how big it is. It probably not that significant, otherwise it would have been mentioned. But this is the first of many, right? And this should be going very well, should definitely help them increase their subscription revenues and be a high margin revenue. And the other thing worth mentioning, there's probably another agreement with Didner coming out in terms of revenue share from other clients. Let's see when that happens, maybe next week. I'm optimistic. But yeah, overall, there's a lot going on, and I think LCFY is in a very solid position right now, especially as an investment, especially with a market cap of below 4 million, right? If they increase their revenues going forward on this cost base, they will very quickly earn a lot of money. And based on that, 4 million market cap is nothing. It's way too cheap. They just need to deliver, and I'm very confident that they will do it. Yeah, that is pretty much what I wanted to say on LCFY. The other one is much more pleasant. So this is SNIPF. They announced, oh, I'm sorry, this is the wrong press release. No, it's the right one. They announced full year numbers. First of all, on time. That is already good, because obviously there was a shadow of the doubt until the last moment due to the heavy delays we had last year. But yeah, they were on time, and the numbers are great. There's no way around it, right? Revenues are up, the highest in company's history. Gross margins have picked up as well. 7 points on the year and 8 points on the quarter. They are positive in EBITDA again. The total second half is EBITDA positive compared to the first half. Backlog is very good. Cash position is very solid, especially if you take into account the receivables as well. There's no debt, very clean capital structure. So what is not to like here, right? Now, obviously that EBITDA number is not particularly impressive, but that's where we are getting to the outlook, because that is pretty fantastic. I also have to say, unfortunately, I couldn't listen to the conference call today. I have received some highlights from friends who have been able to listen, but my impression from the call is that it was as good as it gets. One thing I definitely want to highlight is the strength in the core business. That was apparently also highlighted on the call. And in terms of margins going forward, we will see already in Q1 margin, and keep in mind Q1 is already in the books, right? So everything that was said on the call today, like Atul knows it, as it relates to Q1. Now, for Q1, gross margins will be much higher. They will not be those 39%, they will be above 50, which is yet another jump. Now, that is the case because, amongst other things, but the main contributing factor is that in the Gambit line of business, the deal with Swagbucks ended and it already slowed down in December. So that is also one of the reasons why we have seen this gross margin pickup. But that will lead to a very strong pickup in margins in Q1, above 50%. Now, that will come at the cost of a decline in revenue sequentially. And something else I was about to forget in mentioning is people have pointed out that in Q4 revenues were down sequentially. Yes, and that is normal because the business is seasonal. Q3 is always seasonally the strongest quarter. If you go back to previous years, that is completely normal. And so that trend will continue in Q1. We will have less revenue sequentially, should still be up year over year, but gross margins will be much higher. And if you put all that together, we will see net income also be much higher, and obviously EBITDA as well. And going forward, and that was also a point on the call, SNIP will be profitable. Profits will be growing very quickly. They will be demonstrating the operating leverage inherent in the business with higher gross margins. The core business has the potential to have higher gross margins than historically. You have SNIP Media contributing high margin revenue pretty soon, and you have Gambit also contributing to gross profits very heavily now after the deal with Swagbucks ended. And putting all that together, coupled with the fact that Atul mentioned on the call today, they should be able to grow revenues without commensurate growth in operating expenses, because a lot of that has happened already last year. They already hired the people, right? And now it's really showing profitability, showing revenue increase with fixed cost structure, leading to very strong increase in net income. That is my expectation going forward, and based on that, it's plain ridiculous that the stock is not even up today. Absolutely ridiculous. Also keep in mind on the call, SNIP Media, right? We are also very excited, of course, and on the call they highlighted that they even their expectations were beaten by how well SNIP Media is already doing. And while it is too early to sort of quantify the upside and the revenue potential, it's going really, really well, and it's going much better than they would have thought. So I don't know how much better it can get, right? You're looking at a company that is growing net income going forward, that will show a jump in margins, and yeah, that is almost at the lows, right? No debt, solid cash position, good management. It's really coming together for them, and I would be very surprised if the market can ignore a Q1 just as it seems to ignore this Q4 result, the set of results. When margins jump higher, EBITDA will keep growing strongly. They will finally be able to show operating leverage, and when the business is just booming, as it seems to be doing. Yeah, so overall, I really could not be more happy with that earnings release. From what I've heard. The call was fantastic as well. And yeah, so SNIP is one of my largest positions, and for a very good reason. I think the risk is extremely low here. It's just very hard to see like anything bad happening. Just what we know already, but it's already out there, like in black and white, makes it very, very unlikely that something bad is happening. And yeah, the upside is very, very material. I think the stock should be at least double in the coming quarters, and actually much, much higher. So yeah, I'm very confident in SNIP. I really, really like it. I think for everybody who does not have a full position yet, like your opportunity could not be better. All right, that's pretty much it. So thanks for listening.
Neither Breakout Investors nor any of its affiliates makes any representation or warranty, express or implied, as to the accuracy or completeness of the statements or any information presented by this podcast, and any liability, including in respect to direct, indirect, or consequential loss or damage, therefore is expressly disclaimed. The views on this podcast expressed are those of the speaker and not Breakout Investors. No one on this podcast is an investment advisor, and no one is providing investment advice. Before investing in any company stock, you must do your own research. Thank you for listening.